A company loses $500 million in a single year. Another company posts $200 million in profit. You'd assume Wall Street rewards the profitable one with a higher stock price. Instead, the money loser's valuation is triple. That's not a glitch. That's expectations priced into the present. Stock prices don't measure what a company earns today. They measure what investors believe it will earn 5, 10, 15 years from now. That belief gets converted into dollars the moment you buy a share. This is how tomorrow's stories get priced today. When you buy stock, you're purchasing a stream of future profits. Not the profits a company made last quarter. Not even next year's earnings. You're buying every dollar that company might generate over its entire life, discounted back to what that's worth in today's money. This is why investors obsess over growth rates. A company growing revenue at 5% per year will throw off a certain amount of cash over 2 decades. A company growing at 30% per year will generate vastly more. If investors believe the 30% story, they'll pay far more per share today, even if both companies report identical earnings this quarter. The stock market is a betting pool on future performance. The price you see on the ticker is the collective wager of millions of participants guessing what a business will look like in 2030, 2035, 2040. When expectations shift, a new product launch, a CEO departure, a regulatory threat, prices move immediately because the entire future just got repriced. Price-to-earnings ratio is the scoreboard for expectations. Take the stock price, divide it by the company's annual earnings per share, and you get a number, say 15 or 40 or 90. That number tells you how many years' worth of current earnings investors are paying for upfront. A PE of 15 means if the company froze exactly where it is today and paid out all profits to shareholders, you'd get your money back in 15 years. A PE of 50 means 50 years. Think of it as prepaying for future earnings in bulk. Here's the twist. Nobody actually expects the company to stay frozen. If a business has a PE of 50, investors are betting it will grow fast enough that those future dollars arrive much sooner than 50 years. They're paying a premium today for accelerated earnings tomorrow. A company with a PE of 10 signals the opposite. Investors think growth is slow or non-existent, so they're only willing to prepay for a decade of steady output. Example math to illustrate. Company A earns $2 per share, stock trades at $30. That's a PE of 15. Company B also earns $2 per share, but its stock trades at $100. PE of 50. Same current earnings, wildly different prices, because Company B's investors believe earnings will explode from $2 to $20 per share within a few years. Company A's investors think it'll inch from $2 to $3. The 50 times multiple reflects that growth expectation baked into the price right now. This is why expensive and overvalued aren't the same thing. A high PE looks expensive, but if the company actually delivers explosive growth, that high price was justified. If growth fizzles, the stock collapses, not because the company failed, but because it merely succeeded at a normal pace instead of a hyper pace. The expectation was the expensive part. Wall Street splits the universe into growth stocks and value stocks. Growth stocks trade at high PE multiples because investors are buying a narrative of transformation. New markets, disruptive technology, winner-take-all dominance. Value stocks trade at low multiples because their story is predictable and mature. Take electric vehicles. Legacy automaker Ford has decades of profit history, factories worldwide, steady sales. Tesla had years of losses, production chaos, and a CEO tweeting through scandals. Yet at points, Tesla's market capitalization exceeded Ford's by 10 times. Not because Tesla made more cars or more profit, it didn't. Because investors believe Tesla's growth curve pointed toward owning the future of transportation, while Ford's curve pointed toward managing decline in combustion engines. The narrative matters more than the current spreadsheet. A pharmaceutical company with one experimental drug in trials might have zero revenue. If investors believe that drug will become a blockbuster, the stock price already reflects billions in future sales. You're not buying what the company is. You're buying the probability-weighted outcome of what it could become. This is why earnings reports trigger massive swings. A company beats profit expectations by 2% but guides future growth lower by 3%. Stock drops 15% in a day. The present result was fine. The future story got downgraded. The price instantly adjusts to match the new, less optimistic timeline. Growth expectations also explain why some sectors trade at permanently higher multiples. Technology companies routinely carry PE ratios of 30, 40, 60, because software scales with near zero marginal cost. A utility company with reliable profit might trade at 12 times earnings because growth is capped by regulation and infrastructure. Investors pay more per dollar of earnings when they believe each dollar will multiply faster. The higher the PE ratio, the more perfection is priced in. A stock trading at 80 times earnings has virtually no room for disappointment. If the company grows at 25% instead of 30%, the gap between expectation and reality collapses the stock price. This is how good news becomes bad news. Results that would thrill investors in a value stock get punished in a growth stock because they didn't meet the sky-high bar. This creates asymmetric risk. A company trading at a PE of 10 has modest expectations. It can surprise positively and jump 20%. A company at a PE of 90 has extreme expectations. It has to hit nearly impossible targets just to stay flat, miss by a fraction, drop 30%. Meme stocks and hype-driven IPOs live in this territory. Investors pile in based on a compelling story. Disruption, massive addressable market, visionary founder. The stock price rockets before the company proves it can execute. If revenue growth stalls or competition emerges, the re-rating is brutal. The price wasn't based on math, it was based on belief. When belief cracks, there's no flaw. This is also why overvalued is a squishy concept. A stock can have a PE of 100 and still be fairly priced if growth justifies it. Amazon traded at insane multiples for years, while critics called it a bubble. It grew into those multiples. Conversely, a stock at a PE of 15 can be overvalued if the business is deteriorating. The number alone doesn't tell you if expectations are reasonable. You need the growth story to make sense of the price. Investor sentiment amplifies this. When markets are optimistic, high PE stocks soar because everyone's willing to pay for distant futures. When markets turn cautious, those same stocks get crushed because investors demand profits now, not promises. The underlying business might not change at all, just the collective appetite for risk and time horizons. Misconception 1. High stock price means the company is winning. Not necessarily. It means investors expect the company to win in the future. A stock can be at all-time highs while the business is bleeding cash, purely on the expectation that losses are temporary and dominance is coming. If that doesn't materialize, the high price evaporates. Misconception 2. Profitable companies always have higher valuations than unprofitable ones. Profitability today matters less than the trajectory of future profitability. A startup losing money but growing revenue at triple-digit rates can command a higher valuation than a stable, profitable company growing at single digits. Investors are buying the inflection point where losses flip to massive profits, not the current quarter's result. Misconception 3. PE ratio is the single best measure of value. It's useful but incomplete. A company can have a low PE because it's in terminal decline. Another might have no PE at all because it has no earnings yet, but be worth billions based on future potential. PE works best comparing similar companies in the same industry at similar maturity stages. Comparing a biotech startup's PE to Coca-Cola's is nonsense. They're playing different games on different timelines. Negative earnings. If a company loses money, PE is undefined or negative, which is meaningless. Investors instead use price-to-sales ratios or discounted cash flow models, projecting when the company will turn profitable and what that profit will be worth today. Cyclical businesses. A manufacturing company might show a PE of 5 during a boom year with peak earnings, making it look cheap. But if earnings collapse in a recession, that cheap stock becomes expensive in hindsight. Cyclical PE ratios are misleading without adjusting for where you are in the cycle. Financial engineering, buybacks, dividends, and accounting choices distort earnings. A company might boost earnings per share by repurchasing stock, shrinking the share count without actually growing the business. The PE compresses artificially, making valuation look cheaper than underlying fundamentals justify. Bubble dynamics. In manias, .com, SPACs, crypto, PE ratios become irrelevant because prices detach entirely from earnings models. Investors are speculating on greater fool theory or narrative momentum, not discounting cash flows. When the story breaks, there's no valuation floor to catch the fall. PE ratio is a window into how much faith is priced into a stock. A low multiple means Wall Street expects modest, predictable returns. A high multiple means investors are paying a premium for a story about explosive future growth. That story might be accurate, or it might be fantasy. The price you see today is the market's best guess about tomorrow's earnings. And guesses change fast. Valuations aren't measurements of what a company is worth right now. They're collective bets on what it will earn across decades, compressed into a single number you can trade today. The higher the expectations baked into that number, the more room for disappointment, and the sharper the fall if the story doesn't deliver. That's the price of expectations. You're not buying a business. You're buying a forecast, and forecasts are fragile.